going, guys? Today we're going to learn what a spread is. If you're going down the market watch, we see these 4 columns. So one says bid, another one says asks. This third one says spread. So let me stretch it up a little bit. It says spread. And the fourth one says the daily movement of the market. Then we're going to focus on spread, like I said. So if you see these numbers, 31, 26, 38, 22, 20. To make a long story short, the spread is the difference between the buyers and the sellers. And what do I mean by that? In this example, I'm going to use GBP/USD. I'm going to right click on it and I'm going to go to depth of market. What the depth of market does, it opens up the order book of the trades. Because if you guys don't know what happens inside the charts. So if you guys don't know, say for example, we have this candle here, and what happens inside of the candle is the order book. So all the trades that are happening every minute, every second, they're happening in this price range here, which defines what a candle is. So when the candle is going up, that means there are more buyers than sellers. Or when the candle is going down, that means there are more sellers than buyers. Okay, so it's basically a tug of war. I'm going to divide this in 3 parts. This first part here is the sellers. And the bottom is buyers. So if you see this price range at 1.34365, okay, more or less, it changes every second, every minute, is what the buyers are able or are willing to buy, or the maximum amount of price that the buyers are willing to buy in this market. So they're trading GBP/USD at 1.34361, but they're not paying more than that, okay? And it pretty much goes the same way for the sellers. And the sellers are only willing to sell for a price range of 1.34383 at this exact same second, right? Every second it changes. So it's right now it's at 384. So it could go back to 383, 384, 385. Every second it keeps changing because it's the constant adjustment of the market, okay? So you're only able to open a trade if at whatever price range you chose, there's enough liquidity, or in other words, a seller to sell for you in that price range. So that way you can open your trade, and that way you will know if your trade is gonna go up or down. And it's the same thing when you close a trade. You can only open or close a trade if there's liquidity. So the spread in this case is the difference between the sellers and buyers. And that difference is usually the spread. So if you go down on GBP/USD here, right now the spread is 20. So that means that you're gonna pay 20 cents per 001 every time you open a trade, regardless if it's a buying position or a selling position. Okay. And why is this so important? Why you have to understand this? Because technically saying, the lower the spread, the easier for you. Because basically, this is pretty much what you're paying already just to be in the trade. You haven't even gotten the direction right, but you're already paying that amount once you open that trade right away. Now, for example, let's try an exotic pair, which is EuroMXN.M. Okay. In this market here, you're paying a lot more of the spread. In this exact same moment, you're paying 807 or 761, 750, 755. Like I said, it changes every second. But right up front, you can tell that it's much more than the initial 20. So that means if you are going to open a trade 0.01 on a EuroMXN, you're paying 70.01 cents just for you to open the trade, regardless if it's a buying position or a selling position. Which is a bad thing, because not only do you have to get the right direction, but you also have to get more profit to pay off that spread. So that's why technically saying it is better for you to open trades with a lower spread than a higher spread. All right, and I'm gonna put that in practice. So I'm gonna open a selling trade for EuroMXN. Check what's gonna happen once I open 0.01. All right, right away, it charged me 0.46, which is a lot lower than what I was expecting, right? It's supposed to be bigger than that, but okay. Now let's compare that with the other one that we were talking about, which was GBP/USD, which right now it says it's 20. So what I'm going to do is I'm going to open a buying position again. All right. As you can see, that was a lot lower than that. I don't know what happened to EuroMXN, because it only gave me 50 cents because it's supposed to give me more. But you know what, man? I'm not complaining. And again, because we're only trading 0.01, you're not going to be able to tell a difference because it's very low. But if you were trading 0.05 or even a one lot size alone, for example, a full lot size, it would have been a lot different, because I'm talking about the micro cent accounts, which is nothing right now. But once you really start trading with a more considerable capital, the spread's gonna make a lot of difference, because you can start losing $100 per trade right up front, or $50 or $30 or $20. That's why you have to try and lower as much as possible for the long term. Okay, so that was the spread for you guys. If you want to check the spread from each market, you have to go to Market Watch and see all of the spreads, like I said, and then try to find for the lowest ones. All right, usually the exotic pairs or exotic currencies from weaker countries, or I'm not gonna say weaker countries, but like weaker currencies from countries, for example, third world countries, for example, they're going to be more expensive due to a lot of volatility, because these countries are more volatile. Like I said, there's more risk involved versus a more stable currency like your USD, for example, because we're talking about the biggest countries in the world, right? We're talking about Europe, we're talking about the European countries, and the US, for example, or the dollar, which is a strong currency, right? And just so you know, it's true, I actually opened and closed these trades right here. As you can see, these were the spreads that I opened. For me to just open and close a trade, I am already paying right up front, okay? So again, it was Euro MXN, which was 0.48, and then GBPUSD gave me 20 cents. And one more, because, well, it was actually 21 cents because the market moved 1 pip, but that's pretty much it. Okay, you have to be aware of it, because the goal of foreign exchange market is not to not lose money ever again. You can lose money on the trades, it's okay, but you have to make more than what you're losing, which is what everybody tells you, but rarely people show it to you on the long term, because it's hard to make money. So you could lose minus 48 cents, for example, in one trade, but as long as you're making a positive 194, you are positive. You have a positive 146, and that's all you gotta do for the long term, pretty much, as you can see in these 2 trades here, which is what I'm showing. Okay, again, that was a very basic explanation. I want to go more in depth about it in the future, but I don't want to put a lot of information right up front, because you have to understand the mental model of what it's like to trade a high risk investment. And with that being said, there's nothing guaranteed in this market. There's no easy money. You have to do it at your own risk. This is just what I do with my money, and this is for educational purposes only. You have to take your own risk and responsibility for it. Thank you so much for watching it. I'll see you in the next one. Bye.